Let's have a look at some of the best ETFs from Vanguard, specifically with a focus on growth. So capital appreciation, no bonds in these because there's no appreciation from bonds. So we're going to be looking at equities, and I want to compare all of these growth ETFs to really the stock market in general, which would be an S&P 500 index tracker. So from Vanguard, that's VOO, their tracker, and we'll just compare these growth funds to see if these funds have outperformed the general market, because the S&P 500 has some growth stocks, has some value stocks, and will give us really a baseline to see how these growth ETFs are performing. So VOO has returned 10% over 5 years, and it has a risk of 4, and it trades at $300 at the moment. And wow, I mean, this is just so average in terms of S&P returns. S&P does usually return about 10% or so, and that's exactly what the S&P index tracker has returned. So we'll move on to our first growth ETF, which is VOOG. So this is the S&P 500 growth stocks. So not as many stocks, not 500 stocks. It still has a risk level of 4 though, and it's currently trading at $200 per share for the ETF. And yeah, it is actually outperformed the wider S&P, a 14% return over 5 years and 17% this year. So this growth focused fund definitely outperforming the wider S&P. So what we can take from that is growth stocks in general are outperforming the S&P this year. They're outperforming value stocks. Why is the growth sector in the S&P outperforming the wider market and value stocks? You've got Microsoft, Amazon, Apple, Google, Facebook in this fund, and they are overweight in this fund as compared to value stocks. And those stocks have moved the most in the market. So yeah, it should be outperforming the wider market. They have performed the best. Those growth stocks have. So that's why you see the growth portion of the S&P 500 outperforming. We also have VOOG, which is the large cap growth index. So this is basically an index tracker of large cap growth stocks. So no value stocks in here, no focus on dividend payers or value stocks, just those growth stocks. Again, we've got Apple, Facebook, Amazon, and Microsoft in here, performed very well over recent months. 14% return over 5 years, and this year a 24% return. So wow, that is really outperforming the wider S&P. Now, how this is different is that it isn't specifically an S&P growth fund like the previous one I mentioned. This is a large cap growth fund. So really, this is the biggest stocks in the market that have growth potential. And we're looking at Apple here, and Apple is really drawing all of these indices up. So if you have large cap growth focused ETFs, they are going to have performed extremely well this year. Apple, Facebook, Amazon, these have really outperformed, and so will be dragging returns way higher than the wider S&P, for example. And as we can see, as you're focusing in on those large cap stocks with growth, you really are getting some amazing returns. Then we have VGT, and what is a standout about this fund? So this is a technology focused fund, and I mean, if you were to go back 6 months or so and pick a sector that was going to outperform the market and you picked tech, well, you would have been correct. Again, it is Amazon, Apple, Facebook, Microsoft leading all other indices higher right now, and that's exactly what this fund is focused on. So obviously you can see the returns are fantastic, 22% over 5 years, but this year alone, in the last 12 months, a 33% return. So this fund really is focused on the stocks that have actually been outperforming. So that's why the return is so good. Now, as you can see, the risk level here is 5 as opposed to the other funds which are at 4. Why is it higher risk? Well, it's only focused on one sector. And so the more that you narrow down your investments, the more specific you get, the higher risk level you take, because you're not as diversified. So because the other funds, even though they are focused and overweight on growth stocks, they still have a kind of blend of different sectors in there. But this one doesn't. It really just focuses on tech. It's sector specific, and so the risk goes up. But with that, it really has outperformed the market. Apple is the biggest constituent of this fund, as you can see, and Microsoft is very big as well. And I mean, Apple is an absolute giant, and it has doubled in the last year, the share price. And so when you have Apple as a big constituent in a tech fund, then obviously the performance of that fund is going to perform extremely well. Apple has outperformed the market by a very long way this year. This fund specifically has Apple as its biggest constituent, so a very good performance from that fund. Then we have VONG, which is a different type of fund. It's the Russell 1000 Index, Growth Index. You get 438 shares in here. So the risk level comes back down to a level 4 because it is quite diversified in terms of the sectors and the companies that it is investing in, but still it is investing for growth. A 15% return this year, a 23% return over 5 years. So again, it has outperformed the wider S&P 500, focusing on growth, less on value. You can see it's outperformed. It still has Microsoft and Apple and Google in there. They don't make up as much of the fund as, for example, the tech fund ETF from Vanguard. You also get way more shares. You're more diversified. The more diversified you are, returns usually are going to come down because you haven't really just gone all out in those very overperforming stocks like, well, just Apple. So these growth funds really have done well over the past 6 months, over the past year. Growth stocks in the S&P have been the outperforming stocks. When you are looking at investing, of course, growth is only one area. There is value investing as well and dividend investing, and they have underperformed. So over the last 6 months, especially since everything has happened this year, they have underperformed the market. Although, of course, long-term investors should be diversified, have different levels of growth stocks and value stocks, because over the long term, these things tend to even themselves out. There could be a case to be made that because these growth stocks have performed so well this year, that maybe value stocks are looking undervalued in comparison. Of course, this is all going to be down to the way that you look at it and how you think the outlook for these stocks is going forward. But just as a comparison to these growth funds that have performed very well, if we look at Apple stock, the 1 year return for Apple stock is 100%. So that's outrageous and completely outperforms any of these growth ETFs. If you were just invested in Apple, you would have outperformed everything else. Amazon has returned 80% over the last year, and Facebook has returned a 40% return over the last year. All of those three stocks, if your money was in those, you would have outperformed all of these ETFs. However, they would have been much riskier. As you can see, when you get specific, even with sectors, the risk from Vanguard goes up to 5. If you're investing in one stock, your risk is through the roof, of course. But as you can see, those stocks anyway have performed very well compared to the rest of the market. Interesting nonetheless, and they are some of the most popular growth ETFs specifically from Vanguard. Hope it was helpful. If it was, give me a sub, and I'll see you in the next one.